Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com dives into the latest from the major markets and takes a look at what's happening with precious metals. Publisher of the Gloom Boom Doom Report, Dr. Marc Faber, talks to us from Vietnam about the latest economic action in Asia and how the unrest in Hong Kong could affect China's financial picture. Author of the second edition of the book, When the Bubble Bursts, Surviving the Canadian Real Estate Crash, Hilliard MacBeth looks at Canada's economic health considering the shape of the real estate situation. He also tells us about what it's like being an electric car owner. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Ray. We'll talk to Ross Clark right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Always a pleasure to be back.
Ross, the safe havens, the so-called safe havens, were very busy the last couple of weeks. Did that take place this week?
Well, no, this was the week where the roosters came home, and we ended up after having some really overbought readings. I mean, the weekly RSI readings on silver and bonds. You see, that's the type of thing we've seen in the last 2 weeks that you only see, maybe every 5 or 10 years when you go back historically, and the backside of it's not very pretty. Here we are, gold on the week. You go from 1560 down to 1517. The silver market takes it on the nose by over $1. So these corrections, they were overdue, and all they needed was a bit of a catalyst. And if we look back, it was just a month ago when the equity markets took that real hard nosedive based upon what happened with the yield curve, what was going on with the tariffs, etc. And we had some good capitulations. We spent a month in very, very tight ranges in the S&P and the Dow. And as of this week, now that the tariff negotiations appear to be back on track, sometime in October, meaning that sometime maybe next year that something will come out of it. Just that was enough to break the equity markets out of their very tight range, not making new highs, but breaking out of those ranges and putting a little bit more confidence in one side of the economic equation, took the wind out of the precious metals.
So if you had gone into gold and silver earlier, you'd still be way ahead of the game right now, wouldn't you?
Oh, yeah. I mean, if you were buying at any time, literally from, last summer through until a week ago and came out of it at the end of this week, you're profitable. And, we always have been watching the 20-day moving average as we got into that favorable seasonal period starting in May. And from the end of May on, we were looking for a 6 to 8 week rally initially that would take us into July. The pause that we had during July and early August held against the 20-day moving average, which is a key support. And then we popped to these higher highs in the end of August and first part of September. But as of the end of this week, we're seeing those moving averages break. Not just intraday, but on a closing basis. So from a seasonal perspective, the second half of September through October is typically a very choppy stretch as far as the precious metals are concerned. So the best thing that I could see happen here is that silver pulls back to maybe $17 Gold back around 1,400, maybe as low as 1,360. But a good correction right now would be very healthy for the longer-term trend, recognizing, that we've come out of a 5-year base as far as gold is concerned, and silver's been, had been decimated far more than gold, especially in the last 2 years. But this correction here would be very good. Now, if the equity market doesn't get up and move well here, then the seasonals, the negative seasonals into October, early November might come into play, and you might end up with a corrective low in the precious metals in place fairly quickly and a pretty good chance for a bounce. So we'll be looking for excesses on the downside on the metals. I think it's going to take a few weeks at least to unfold, so I wouldn't be in a rush to be spending money there right now.
Ross, thank you so much for chatting with us.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Dr. Marc Faber next on This Week in Money.
Always consult your investment professional before making any investment decision.
Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report online at gloomboomdoom.com. He's speaking to us from Vietnam. Welcome back to the show, Marc.
Well, thank you very much for having me on your show.
Marc, U.S. manufacturing has contracted for the first time in 3 years. Does that mean a recession is around the corner for the U.S.?
Well, not necessarily, but or because manufacturing is no longer that important in the U.S. as a percent of the economy. But it's one indication that the economy has slowed down meaningfully. And the service sector, by the way, is not doing particularly well either at the present time. And there are many indicators like durable goods orders or air freight traffic or container shipping in the U.S. and so forth and so on that would rather suggest that, like other countries in the world, the U.S. is entering a recession. I thought that the peak economic activity in the U.S. was in October, November of last year, and since then that we have slowed down meaningfully.
Is China putting additional currency controls in place?
That we don't know for sure, but basically the Chinese RMB has been weak, but it hasn't been weaker than, say, the euro, or it hasn't been weaker than other Asian currencies or Latin American countries' currencies. So one shouldn't exaggerate the weakness of the RMB or the yuan, as some people call it.
Do you think a China-U.S. trade deal will get done?
Optically, maybe it will be done, but it will not solve the problems, because the two sides are so far apart, and any trade deal would not reduce the trade deficit meaningfully. So it's possible that the trade deal will be done, but it would be kind of more for show than a trade deal that holds any meaningful results.
Are companies moving out of China, and if they are, where are they going?
Yes, that's a good question. Well, some companies are moving out of China, but they've done that for years because some manufacturing, like manufacturing of garments and textiles and so forth, they don't require a very high level of technology, so they moved to, say, Bangladesh or India or Sri Lanka, but that they've done for years. Some companies have also moved to Vietnam, but they've also done that for years. If you go to Vietnam, there's a large presence of Chinese, Koreans, Japanese, Taiwanese, and so that has happened for a number of years. And the successful Chinese companies, they already have manufacturing all over the world, including Vietnam. So whether they manufacture out of China or out of Vietnam will not change things very much.
Are the Hong Kong protests spreading into China?
That I doubt, because first of all, the Hong Kong Chinese don't like the mainland Chinese, but vice versa. Because you have to understand, the mainland Chinese, they remember that they went through hardship during the Civil War or the Second World War, and then they went through hardship under communism, under Mao Zedong and so forth. And then they came up, and the Hong Kong people always looked down on them. So in a way, the mainland Chinese are kind of, exhibiting some kind of a Schadenfreude. And they have nowadays cities that can compete with Hong Kong. And therefore, I think that the unrest in Hong Kong is unlikely to spread, which was the hope of some people, certainly in the U.S.
Is China as reliant on Hong Kong for its economy as it used to be?
China does not depend in any way on Hong Kong.
Do you think the people in Hong Kong might overestimate their importance to China?
They have always overestimated their importance because of their inbred arrogance, and they always thought that they have the only deep water port. They only thought that they always thought that they have all the knowledge, that the Chinese have no knowledge, and so forth and so on, and that China would need Hong Kong. I think that Hong Kong needs actually China. That was already the case under the British, because all the water in Hong Kong comes from China.
Is that one of the ways they could cut the protests, cut the water?
The protesters would go on because their agenda is not very clear. Actually, already now, they're acting against their self-interest. The protests are very negative for Hong Kong and for its economy, and indirectly it will touch the protesters also if the economy tanks, as it has begun to do. So they're actually acting irrationally, completely irrationally. And in my opinion, I wrote a book about the rise and the fall of cities in 1997 when the handover of Hong Kong occurred from the British sovereignty to the Chinese sovereignty. In fact, they are accelerating the decay of Hong Kong.
We'll have more with Dr. Marc Faber when This Week in Money returns.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Dr. Marc Faber. Mark, is communism bad for financial markets?
Communism is very bad for the economy. Under communism, there is practically no financial market. There wouldn't be a stock market. Now, I don't know which country you perceive to be communist. At the present, we have a communist country in North Korea, but we have a more than capitalistic system in China than in most Western European countries and the US. But it's a one-party system.
Is socialism bad for financial markets?
Socialism is very bad for the economy, and therefore it is likely to be bad for the economy and the financial markets. In other words, say, if the socialists win the elections in 2020, it is likely that the financial market will have gone down ahead of it, because the stock market is a discounting mechanism, and that it will continue to go down after the elections. But you cannot, in general, just say socialism is bad for the stock market or is good for the stock market. In France, under the socialists, the stock market has frequently done well.
How are world stock markets behaving right now?
Miserably.
Is there any general reason, or is this just a cyclic downturn?
I think you started out the interview by asking about the economy. We have a very meaningful slowdown. I'd say half the world is in recession. Half the sectors, the industrial sectors, the service sectors are in recession. Maybe even more than half. And the stock markets in general are not very cheap. They are expensive. However, if you tell me what would you rather own, some shares or a 10 years German government bond at a yield of minus 0.7% annually, or Swiss franc bonds at a negative yield of 1.1% annually, then I'd say, yeah, maybe stocks are a better value than these negative yielding bonds.
Who's buying negative yield bonds? Why would a person do that when you can still get positive bonds in North America?
We have regulation in Europe that requires pension funds to invest in sovereign bonds. They require life insurance companies and other insurance companies to invest in sovereign bonds. And then we have global bond funds, index funds, that then have to buy negative yielding bonds. And by the way, if you bought a negative yielding bond at a negative yield of 0.1% and it goes to minus 1%, you made a lot of money. You understand? There is money to be made, actually, among negative interest rates. Probably not in the long run. But the other thing is, if you tell me, look, the dollar will weaken substantially against the Swiss franc, real estate will collapse by 30%, stocks will collapse by 50%, art will go down by 50%, then maybe to buy a bond, a Swiss zero coupon bond that matures in 10 years at 111, and you get back 100. So in other words, you lose 11% over 10 years, but you lose less than in stocks, you understand? So that is the way some people might think.
Are gold and silver now in bull markets?
I think so. And I think we may actually be at an early stage of the bull market, and that it could last for quite some time because of the zero interest rates that you get, or the negative interest rates you get. So in other words, if you tell me here you can buy bonds at negative yields, or you can buy gold that doesn't have a negative yield, but the prospect of actually some appreciation, then a lot of people will say, well, in this case, let's buy some gold.
What kind of price targets are you hearing for this bull market in gold and silver?
Well, this we don't know, because it will depend very much on the stupidity of central bankers. And since the stupidity of central bankers seems to be unlimited, the price increase in gold, silver, platinum could be very strong. But I wouldn't know how far it will go. I think it's quite likely that we will take out the previous high at $1,921, and that if there is a bull market, that silver and platinum will outperform gold.
Does it look like we're moving from an inflationary environment to a deflationary environment?
Entirely possible, but the inflation-deflation discussion is very complex, and I can't deal with it in 5 minutes, because you can have in an economic system some items that are inflating and others that will deflate. But as I said, it's very complex. The negative interest rates that we're seeing seems to suggest that we are more likely to experience deflation, certainly in asset prices, than inflation. So we had inflation in asset prices in the last 30 years, not so much in consumer prices, and now the negative interest rates suggest a deflation of these asset stocks and real estate and art and so forth.
Does it look like interest rates have bottomed?
Well, in my opinion, it hasn't bottomed yet. Let's look at, say, some bonds. You can buy a 10-year American U.S. Treasury at a yield of 1.45%. You can buy a Swiss franc bond at a yield of, as I said, minus 1.1% per annum. You can buy Greek government bonds at a little bit higher yield than U.S. Treasuries, 1.58%. You can buy Italian bonds, 10 years, always at 0.87%. You can buy Spanish bonds at 0.1%. Now you tell me, what would you rather own? Italian bonds, negative yielding bonds, or a U.S. Treasury? So the Treasury market, although it's near-term overbought, I think can still go up. In other words, yields down.
Could a black swan event cause interest rates to move a lot higher?
If it's really black spot event, I'd rather think that interest rates would go down and not up. But eventually, of course, they will be higher, eventually. But, eventually it can be in 3 years, it can be in 5 years. It could take some time.
We'll have more with Dr. Marc Faber when This Week in Money returns.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Marc Faber. Mark, could the U.S. economy prosper while the rest of the world goes into recession?
Most unlikely. Most unlikely. I wouldn't say impossible, but most unlikely, because we live in a world where economies are connected, they're interrelated. If you have weakness in one country, it's likely that it will affect the profitability of the multinationals, a lot of which are domiciled in the U.S. So to have a global recession without the U.S. would be most unlikely.
China is restricting the purchase of foreign real estate by people from mainland China. Could this affect real estate markets around the world?
Yes, for sure it will affect real estate markets around the world, especially the ones that attracted a lot of Chinese buying, Vancouver and the west coast of the U.S.
Is the next step for China likely to be the forced repatriation of funds to China that have been used to buy foreign real estate?
They could do that. It's not very likely, but it could happen.
Are you bullish on the U.S. dollar going forward?
I think the U.S. dollar is extremely overbought, is way out of line with other currencies. In other words, it's too expensive compared to other currencies. It makes the U.S. uncompetitive. But, foreign exchange moves, they can go on for a long time, as well as stock market moves. We had, the Nasdaq moving up more than anyone would have predicted. So it's very difficult to say, tomorrow it's going to peak out. I think the next big trade will be to be short U.S. dollars. But should you do it today or tomorrow, in 3 months, 6 months, 1 year, who knows?
Is Canada potentially a rare earth rich country?
Rare earth. Yeah, if they found sufficient rare earth, they will be very rich. For now, they're wealthy because of oil and also because of minerals, especially precious metals. But I'd say this. If you look at the currency movements this year, most currencies are down against the US dollar, the major currencies for sure. But actually, the Canadian dollar is up 2%, 2.2%. So it may signal that gradually the Canadian dollar is bottoming out and that it will appreciate against the US dollar.
Would the push for a hard Brexit or no deal Brexit be likely to affect financial markets?
Well, it has affected the British pound already, in the sense that it came off sharply. But at the present time, the short position in the British pound is very high. And so any news or good news could actually lift the British pound quite considerably.
Your thoughts on cryptocurrencies?
I think I mentioned in an earlier interview that when bitcoins hit 3,000, 3,200 earlier this year in March, I thought that the cryptocurrency market was bottoming out and that people should take a small position in cryptocurrencies. I think that my generation of people who are used to carry cash is dying out, and that in future some kind of other system, monetary system, will replace the present system. The present system is largely in the hands of academics at central banks. Cryptos will not be beholden to these academics. So I think, yes, there is a great future for cryptocurrencies, but it's not yet problem-free. Security is a big aspect.
Overall, do you see gloom, boom, or doom ahead for the world?
Well, I'd say for the last 12 months, the global economy has decelerated massively. I'm here staying in a villa of a hotel my partners and I built. We sold it then, and it's run by Four Seasons. I can say that the occupancy is significantly below budget. In other words, the slowdown has taken a lot of people by surprise, and I've written about this about 6 months ago or 9 months ago about the slowdown in the tourist trade in Asia, because I can see it with my own eyes. You don't need to be an economist or an academic to see it. You just have to be observant and not pay attention all day long on your mobile phone. And I wrote about this, and now it's happened, and I think it will get worse. Especially, you have to understand, there's a group of people that spends a lot of money, but they spend a lot of money because they made money in the asset markets, in stocks, bonds, commodities, and everything. And if the asset markets go down, then obviously their wealth will shrink, as well as their appetite for spending. And consumer confidence is already declining.
Can you tell us about the Gloom, Boom, and Doom report and how people can find out more about it?
Well, I have a website, gloomboomdoom.com. I repeat, gloomboomdoom.com. And they can subscribe there to the monthly report, which comes out, as I said, monthly, and is sent out by email. Or they can subscribe to the Gloom, Boom, and Doom report, which is a printed paper that also goes out monthly.
Mark, thank you so much for being on This Week in Money.
Well, it's my pleasure. Thank you very much.
My guest has been Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom report online at gloomboomdoom.com. He was speaking to us from Vietnam. Coming up, Hilliard MacBeth, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth. He's a portfolio manager in Edmonton and the author of the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash. Hilliard, welcome back to the show.
Nice to be on in the show, and it's summer here in Edmonton, so it's finally summer's arrived.
Just in time for fall.
Yeah.
Hilliard, where can people get copies of your book?
You can buy it online, and all the usual subs, like Amazon and Kobo and that sort of thing. And then for the electronic version, then you can also buy it online for the printed version, or you can buy it at all the best bookstores. The ones that are left anyway, which I guess is mostly Chapters and Indigo and a few independent ones left, but.
Hilliard, this week the Bank of Canada decided not to change the central bank rate. What is the Bank of Canada likely to do going forward?
Well, the next meeting is the end of October, and that'll be after the election, and so they're not likely to do anything before the election. But I think their next move will be a cut in the rates, because that's the trend worldwide. In fact, well, as you and I have discussed several times, a huge portion of the world's interest rates now are negative. So Canada's the outlier where the rates are still relatively positive, and that's what they'll do at the next meeting. And the other thing, of course, is the justification for not cutting is numbers that came out recently that showed the economy was still pretty strong, but in Canada. But I don't expect that to last either.
You're absolutely right. Stats Canada just releasing the latest GDP numbers showing the last quarter GDP was 3.7%. Is that number accurate or just a blip?
It's accurate in the way they calculate it, but there's two things to know. First of all, is how they calculate it, and secondly is the individual items underneath. So first of all, on how they calculate it, I think people will be surprised to learn that they actually just take the quarterly number, which in this case was 0.9 something, and then they multiply it by 4 to get the annual number. So 0.9 something times 4 comes out to 3.7. But that makes the number very volatile. So in reality, I looked back a year ago until the end of the last quarter that was reported, and the gain was actually only 1.6%. So we've recently had a really good quarter, but if you add up all the numbers for the full year, which is what the annual rate really should be, in my opinion, it only comes in at 1.6%, which is probably pretty accurate. 1.6% is kind of the latest numbers for the U.S. have been, they had been above 2% growth, and now they've been coming down below 2%, around 1.9. It's pretty hard for Canada to grow faster than the U.S. since we're an export country, and we depend on the U.S. as our largest customer. And then the second thing, inside the numbers, there was some. So one of the big components in Canada, because we are an exporting nation, is the adjustment that's made for exports and imports. So they actually take the value of exports and they subtract the value of imports to get a net export number, and then they add that to the GDP. Well, one of the biggest contributors to the GDP, there was a rise in exports, which is primarily oil related, but there's also a big drop in imports. So the decline in imports, being a subtraction, becomes a positive number, and that gets added to the GDP. The problem with that is that a drop in imports is a signal that the Canadian consumer is getting cautious, or maybe is running out of room on his or her credit card, or just has run out of borrowing power on refinancing the mortgages, or maybe it's just psychologically decided now is the time to save rather than to spend. Although that last one's unlikely, but it's possible.
With falling interest rates, how hard is it for the banks to stay profitable in the future? In Europe, Deutsche Bank, for example, is in huge trouble.
So Deutsche Bank in Europe is not a good indicator of this problem with negative interest rates. So because they don't really do retail banking, so retail banking would be the indicator. And actually, the retail banks are doing quite well. So this whole thing about negative interest rates doesn't affect the banks nearly as much as people were saying several years ago. People several years ago were saying that the banks are really hurt by low interest rates and would be really helped by interest rates going up. And that back when we expected interest rates to go up, and myself included. And they didn't go up; they went down. But the banks continue, as we see in Canada, they continue to report record profit. Actually, the profits lately have been a little weak, but they're still close to record profits. So that proves what we've talked about before, and that is that the banks don't really need to borrow money to lend money. When they lend money, they just create new deposits and new loans by creating the loan itself, and that creates a deposit and a loan, and the profits come more in line with, did they make a good loan? Does the borrower pay the loan back? How many defaults are there, and that sort of thing, not the spread between deposits and loans.
Now, of course, I saw this private policy paper from the banking industry where they pretty well consider it their right to collect 2% of your income no matter what. And I take a look at rising service fees every year. I don't see the service change or improve any, but they seem to charge you a lot more for it.
Yeah, they have ways. In fact, even in Denmark, people are kind of hyperventilating a bit because they actually have negative mortgage interest rates in Denmark. So you can get a mortgage and pay back less money 25 years from now than you paid back, than you took out. But it turns out that the cost of the mortgage is still a positive number, because what they do is they charge fees for managing the mortgage, even though the actual interest rate on the mortgage is negative. So exactly. So the banks will find a way to make their profits.
How bad is the private debt to GDP ratio in Canada?
It's one of the worst in the world. So it was interesting. So I wrote my book in the first edition in 2015, and at that time Canada had basically had 6 years of household, mostly mortgage debt, increasing faster than GDP. So the ratio kept going up. It had been comparable to the U.S. prior to the financial crisis, at about 150% of GDP. It got to 200% of GDP, and 100% of GDP, and the U.S. rate just kept dropping and dropping, and the Canadian rate kept going up. But when you add the private sector corporate debt as well as the household debt, which I didn't talk about in my book very much, you get up to 218%. So the fastest growing component of private sector debt turned out in the last couple of years, since the first edition came out, to be corporate debt. And a lot of that corporate debt, of course, is in loans to businesses that do real estate construction and real estate development. So it's the fastest growing segment. So, and the numbers, even the most recent numbers, we're talking the last 3 or 4 months out of the banks, show continual double-digit increases in business loans, while mortgage loans have slowed down to the point where they're barely, I think the actual number is around 3.4%, but that's almost no growth at all compared to the 7-8% that we had for many years.
Is Canada likely in a recession now?
You know, I think certainly parts of Canada are. Like in Alberta, I think the conference board just came out and said, you know, they say, well, Alberta's in a technical recession. I don't know what the difference between a recession and a technical recession is. The definition of a recession is sort of widely known to be 2 quarters of negative growth, but actually the people that officially certify the existence of a recession take more things into consideration than that. And one of the, you know, some of the things in Alberta, a massive collapse in capital investment, mostly that previously was going into the oil and gas industry, big slowdown in housing construction, and now the government, of course, as the Blue Ribbon panel has reported, and has indicated that the government of Alberta should cut back on spending dramatically in order to balance the budget by 2022, 2023. And if they go through with that, and I don't think there's any doubt that they will go through with that, because the new government under Jason Kenney ran on that promise, that'll make the recession worse, and it'll also start to impact all of Canada, because Alberta's a much bigger portion of the Canadian economy than just the 11% population. The rest of Canada, British Columbia, the real estate industry is so large a component of British Columbia, it could be, you know, flirting with the idea of recession. The only part of Canada where there's really still a pretty strong economy is Ontario. So if you took the overall, Ontario being so big, you would show that Canada was growing at 1.5%, 1 and 2%, somewhere in there, which is not a recession. But significant pieces of Canada are probably already in recession.
What is a Minsky moment, and does it apply to Canada?
Well, it certainly does. So the Minsky moment, one of the things that, you know, people will notice probably if once it's pointed out to them, is that almost all the discussion in the media and economists and even interviews like this talks about the government being in debt. The government is in debt. The government has to balance its budget, and that's what Jason Kenney in Alberta talks about all the time. But that's not really the problem. The problem is private sector debt, and Minsky was the one. The economist, he died in about 1983, and he wrote a lot of his stuff in the 60s and the 70s. And he had been in the private sector. He had worked for Wall Street banks, and then he'd become an economist. Like a lot of these heterodox economists, as they're called, they seem to have some private sector experience before they get into economics. And he talked about the moment that is reached when the lenders, primarily the banks, but it could be other lenders, realize that all of the loans that they put out are unlikely to be repaid. And so what they do at that point is they start to demand the loans. If they can call the loan, they call the loan and seize the collateral. And if they can't call the loan, like in the case of a mortgage, they can't call mortgage loans, they just stop making new mortgage loans. Well, the effect of that is to cause a recession. And it also, the bigger impact, which is where the Minsky moment primarily talks about, is it drops asset values. Because asset values, whether they be houses or stocks or business investments, are dependent on a continual flow of new money from loans that go in to prop up the value of the assets. So if the flow of money in a Minsky moment ends, then asset values have to drop, and now you got a new problem, because now the collateral behind the previous loans that were in isn't high enough, and all the loans are in trouble, and it cascades into a Minsky moment. The other person that wrote about that years before was a fellow named Irving Fisher, and he had something called the debt deflation theory, which was actually really a pretty interesting theory, but mainstream economics didn't like it, so they basically ignored it. And Minsky talked about it, and they kind of ignored Minsky too. So, but the Minsky moment became popular because of the global financial crisis. And it's in my chapter on the Canada's Addicted to Debt in the book, I talk a lot about how the Minsky moment works, and it's really something that everybody should understand, because we're going to live through it at some point, probably fairly soon.
Is China's economy in deep trouble?
So there's a way that you can avoid the Minsky moment, and that is if the government and the banks are willing to continue to create a new flow of money into the economy for more productive purposes, and if those loans continue to generate the assets that are created by those loans, or the assets that are purchased by those loans, produce enough revenue in terms of income that they can service the loan. So the Chinese government has been phenomenal. It started in about 1980 when they decided to, under Deng Xiaoping, to become a modern economy. So they've basically gone about, it'll soon be 40 years, and they've expanded the bank loans. They've directed where the loans go into what they consider to be important areas, and the economies continue to grow much faster than any other large economy in the world. And it's worked. Now, at some point, remember when we talked about the Minsky moment, I mentioned that lenders decide that they panic because they realize the borrowers can't repay the loans. Well, if the government is standing behind the banks, and if they're talking about it, and they decide, okay, we'll write off all those bad loans, but we'll keep making new loans, there doesn't necessarily have to be a Minsky moment, and it can carry on. But eventually what happens is the economy gets weighted down by a whole bunch of bad loans that the government can no longer prop up, and a collapse does come, although it's a little bit different from a traditional classic Minsky moment. So the problem with predicting whether China's in trouble or not is the fact that they do have control of the credit creation process. They do allocate capital. The government and the Communist Party is involved in allocating capital, and they could keep it going theoretically for a long, long time. Having said that, though, the economic growth numbers are coming down quite rapidly, and we know that they're probably made up, but the direction is lower and lower and lower, and they could get into trouble for sure.
Did China inflate their currency, resulting in excessive bank debt?
You know, I don't think China would want their currency, being an exporting nation, I don't think that China would want their currency to be any stronger than it was. And lately it's dropped from about 6.6 to the US dollar down to about 7.18. So that's quite a big devaluation. That would be a devaluation. The bigger the number, the weaker the Chinese yuan. But if the natural course of events were allowed to happen, China would have actually had a stronger currency, because they generate a lot of their income from selling stuff to, at least in the past they did, to U.S. Consumers, and they get U.S. dollars, and the normal thing would have been to bring that money back to China and convert it back to the local currency. But they didn't allow that to happen, so they kept building up, and this is where everybody knows about the massive, I think it's $2 or $3 trillion of U.S. dollar reserves that the Chinese government holds, and the reason for that huge amount of reserves is this thing I just talked about, which is they leave the money in U.S. dollars, which is unusual, and so if they'd allowed that money to come back to China, and be converted into yuan, the local currency, it would have pushed the currency higher and higher and higher, and then that would have wrecked their export competitiveness. Their export competitiveness, even before this trade war, was already in question, and people were talking about moving factories to Vietnam and other countries. I don't know how many of them actually moved, but the manufacturing giant that China had become was starting to falter a little bit. So no, I don't think they would have been manipulating their currency higher, and only recently have they started to let the currency slide lower. And that is recently the U.S. declared China a currency manipulator. But I don't know that that's correct. I think it was more of a political declaration than a true economic declaration.
How dangerous is China's bank debt?
Well, it's like any situation that eventually there will be a crisis, a financial crisis. Once the bank debt gets beyond about 150% of GDP in total, the household plus corporate. I mentioned Canada was at 218, so Canada's way beyond the threshold. Then a financial crisis becomes inevitable, and it's just a question of when, not if. So China's in that category. As a matter of fact, China and Canada are kind of fighting for the number one spot in the world in terms of private sector debt to GDP. But it is dangerous, and it is eventually going to be a problem. It's just unlike in Canada, where it's likely to happen fairly quickly because we don't have a history of the government intervening. We sort of let it happen, and then we fight the crisis rather than forestalling the crisis. In China, they do have a history of controlling things more. So they might keep it going a while longer, but eventually they will have a financial crisis.
Is money from China still flowing freely into Canada?
Well, no, I don't think it is. And there's several things happening. One of them is the money laundering, which I didn't write very much about because it's so hard to get information about money laundering. But in the last 4 years, I've met with several of the people, one of whom is a lawyer, Christine Duhame, and I think maybe you've interviewed her.
Yes.
She's brought a lot of this stuff to everyone's attention, and there's also something called Transparency International, and they've highlighted Canada as one of the worst offenders in terms of not living up to the international anti-money laundering agreements. So now that this has become public with the issues with especially in Vancouver, but also in Toronto, and not just China, but also Iran, there's a chill over everything. One of the things that was made it very easy for foreign money to come into Canadian real estate was our exemption on real estate transactions if it was a principal residence. Now, a lot of these residences were not necessarily principal residents, but you didn't have to file a form with CRA. You just took the exemption and hoped they never caught up to you, even though maybe you didn't live there. Now, the change, it was quietly done about 2 years ago, requires every transaction to have a form filed. So the last thing these foreign speculators / investors / money launderers, depending, they're not all money launderers, but some of them are. The last thing they want is a form to be filed with the government agency having to talk about what the ownership of the property is, how much money was made, what was it bought for, what was it sold for. They don't want to do any of that. So since then, basically the Vancouver housing market peaked in July of 2016 for the single-family home segment, and especially at the high end, prices have been tumbling. And at the high end, it's not unusual now to see $10 million homes selling for $5 million, a 50% drop. Now, when you look at the index, it only shows a 9% drop. But at the high end, where the money launderers are most active, the drops are much, much larger, and that's an indication that the money is not flowing out of China anymore. And then just one more thing on that. The fact that they allowed the Chinese currency to drop from 6.6 to 7.18, a pretty big double-digit decline, indicates that they are confident that they've got capital controls on money flowing out of China. Because if they didn't and they dropped the currency, that would just would turn the flow of money into a huge raging torrent of the biggest river of money flowing out. So that they must have found some way to clamp down on the transfers. I've been told by people that are working on projects in Canada that the project has fallen through because the normal application for large money transfers, you'd get an answer in China back within 1 month, and now after 9 months they still don't have an answer. So the project fell through because it was dependent on capital coming out of China. So I think if it hasn't completely stopped, it certainly is much, much smaller than it used to be.
As China's economy slows, could this affect real estate in Vancouver and around the planet?
Absolutely. I mean, it isn't just Vancouver. In fact, Vancouver dropped out of third place in popularity in North America to fourth place. Seattle. So Los Angeles has always been number one. San Francisco has always been number two. Vancouver used to be number three, but then Seattle jumped in front of Vancouver. So now Vancouver's number four. And that's just in North America. And then, of course, you've got Australia, where the huge amount of money has gone into it, and New Zealand as well. And those countries, unlike Canada, have taken more aggressive measures to stop foreign money coming in. Now, it isn't totally stopped. You can still, I don't know exactly what the details are. They keep changing the rules, but whether it's new housing or used housing, there's different rules. But they've made it harder for foreign money to flow into those countries. And but even if they don't change the rules, if people can't get their money out of China, then it'll have a huge impact on real estate all around the world. And I think Canada will be impacted more than most people because other than Australia, I would say Australia and Canada are pretty similar in this respect. The prices here are much, much higher. So if it's dependent on the flow of money out of China, we'll feel a much bigger impact. The local buyers are not as big a factor in homes that are 5 million or up. I just checked this week, and there's 483 homes for sale in the Greater Vancouver area at 5 million and higher. There's almost nobody in Vancouver that can afford a $5 million home based on their income. So if the money isn't flowing out of China or Iran anymore, because the authorities are scrutinizing it closer, then how will those homes find a buyer? It's going to be very difficult.
We'll have more with Hilliard MacBeth when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, is Canada likely to see a decrease in university students from China?
You know, it's interesting. I was doing research on my book, and I found a professor at the University of Toronto who had done some work on related items, and so I arranged a meeting, and I walked from downtown Toronto up to the university, which is about an hour walk. And as I got closer to the university, of course, there were more and more students, and I really was shocked at the percentage of students that were. Now, who knows if they're Chinese or if they're Canadians that look Chinese or what? But it seemed like the proportion was extremely high. And when I got to the meeting with the professor, I said something about this, and he didn't respond at all. He didn't say a word because obviously the professors realized that because the foreign students pay such a large the tuition that's much, much higher than the Canadian students, and tuition isn't low even for Canadian students. It's a huge economic support to the whole infrastructure and salaries of the university in Canada. So, you know, if this trade war turns into something more ugly, it's pretty ugly already, but if it gets even a little bit more ugly, and China calls all their students back to China, or punishes Canada by transferring ordering them to be transferred to another country, it would be devastating to Canadian universities. I don't know if it's going to happen, but it would be devastating for sure.
What's the latest on the lending attitudes of Canadian banks?
Well, the Canadian banks, first of all, they were much more aggressive in their lending than they're willing to admit. And I've had personal experience with this when I described one transaction that where a young couple was offered $1 million loan to buy a house. And I was talking to a senior banker in Toronto in June, and he didn't believe me. And he said, well, that must have been some, one of those alternative lenders, those private lenders. And it was one of the largest banks in Canada. And I was there in the meeting, so it wasn't secondhand. I heard it from the banker's mouth, $1 million, no problem. And it was the bank that the senior executive was the same bank. And he didn't, I told him, it's your bank. And I won't mention the name of the bank because it doesn't matter. I think they were all the same. But he just flat out did not believe me. So that tells me that even the people within the bank don't know how aggressive their people in their branches were being with some of these loans. So in a visit to that same branch of that same bank, talking to a different banking official, I put the same scenario out, and I got an entirely different response. I got, oh no, we don't do that anymore. It's like, I said, well, the guy before, I think his name was Gary, he said, $1 million, no problem. And the recent interview with the banking official, she said, oh no, Gary's no longer with us. We don't do that anymore. But I heard that, I'm not kidding, I heard it more than a dozen times from people in Edmonton, Calgary, and Vancouver, and I'm sure they were doing it in Toronto. They were doing it everywhere. So, and this is for a young couple with, say, $250,000 to $200,000 in income. So, I'm sure that has changed, and I'm sure that it's much more, the lenders are much more cautious. But the only reason they were doing that was to meet their quotas. They have tremendous pressure on the personnel in the branches to put out so much in new mortgages, so much in new HELOCs, so much in new credit cards, so much in new auto loans. And they're kind of dependent on the people that walk in the door as to who they can do that with. So the only way they can really increase their volume is to increase the size of the transaction. So one of the things that was uncovered by the Australian Royal Banking Commission, which was just reported recently, would be to take away that bonus system, because the same thing was happening in Australia. And it's just crazy to bonus people who have no control over really how many sales. They shouldn't even be called sales. The placing of a mortgage shouldn't be called a sale, but it is. Mortgage shouldn't be called a product, but it is. There really shouldn't be a connection to their personal income based on how many people they talk into taking out mortgages and how big those mortgages are. And that this came out of the Royal Banking Commission in Australia. And I hope we have one someday in Canada as well. But generally you don't get approval to do investigations like that until there's a serious problem with people not being able to pay back their debts. So it's not going to happen right away, but at some point maybe it will.
Bank economists are suggesting that Canadian real estate is taking a slight pause. That's their term. Your thoughts on that?
Well, this is the classic soft landing argument that I've been hearing for 4 years now. And that the history in other countries and the history in Canada, if you go back, you have to go back 30 years in Canada to get there. You have to go back to 1990 to get a similar situation. And it's not that similar because today's situation is much more extreme than the 1990s. But everybody was saying exactly the same thing in the 1990s in Canada, and everybody was saying exactly the same thing in 2007 in the United States and Ireland and Spain and everywhere else where they had a crash. And there's some famous quotes by people like Ben Bernanke, the chairman of the Federal Reserve, saying, yeah, we'll probably, I'm paraphrasing, but it's very similar. We'll probably see a pause, but generally house prices never go down, something like that. Yeah, no, when you get a Minsky moment and a housing crisis, house prices, not only do they go down, but they go down by a very large amount, which is what devastates people who have large loans outstanding. And there's really no way to have a correction without that. Otherwise, if you just get a pause and then prices resume their upward trend, you haven't solved any of the problems. You haven't solved the debt problem, and you haven't solved the housing unaffordability problem. So all it really is just a continuation of the bubble, which just means that the crash will be worse down the road. So I would argue that the correction's already started. The bank economists say this is a pause and it'll go back, which all they're really saying is the crisis is coming soon, just not today. But that's what everybody would say, because nobody wants to the crisis. There used to be a saying in Alberta saying, just give me one more boom and I promise I won't piss it away this time. And of course, since that bumper sticker came out in the 1980s, we had two more booms. Not one, but two more booms. And people did exactly the same thing they did the first, second, and third time. They spent it all, and there's nothing left. That's why we've got this big crisis in the Alberta government. You know, you'd think that we would have saved up some of the money. So it's the same in this current situation with housing. There are so many people in Toronto and Vancouver and Edmonton and Calgary dependent on the housing bubble continuing that nobody wants to say that it's going to end.
What is the latest on high-end real estate in BC and Alberta?
Well, in BC, it's just a disaster area. West Van is kind of the epicenter of it, but Marine Drive and other places like that, there's houses that are. I'm talking about Vancouver. Houses that are not selling at even, you know, as much as 40 or 50% off of the high price, which is back probably in 2015, 2016. And some houses have sold. If you follow me on Twitter, it's called at HMACBE is my handle, or you can just look up Hilliard MacBeth. It's easy to find. And I retweet some of these. There's quite a few active people that bring out the listings. They track the listings. Then when it sells, they report how much it sells for. And I've seen some where the prices are as low as 2011 prices, which goes back, doesn't go all the way back to the start of the bubble, but it goes back to about half of the bubble. The bubble started in 2003, 2004. So that erases all of the gains from the last half of the bubble, which is pretty amazing. And that's a very substantial percentage drop from the peak prices. So, and in Calgary and Edmonton, prices are very soft. We haven't seen anything like the 50% drops, but there's an awful lot of houses for sale that are just not selling. Anything above $1 million is extremely difficult to sell. And even in Toronto, for the single-family homes, the expensive ones are not selling. But what's propping the average up in Toronto is the activity in the multifamily condo market, where prices, the condo developers seem to have some kind of magic elixir where they can get people to pay higher and higher prices. Although it came to an end in Vancouver, now Vancouver's condo prices are actually dropping, but they're still keeping it going. And I don't think for much longer, but they're keeping it going still in Toronto.
Are the sellers of high-end real estate reluctant to price their properties according to where the market is?
Well, for sure. I mean, a lot of the people that own those expensive properties, well, there's two categories. It's a lot of work. I didn't do the work, but if you looked at those 483 properties of $5 million or higher in Vancouver, a lot of them would actually be brand new homes where the speculator has torn down the old home, built a brand new home, is trying to get. So I think, and this is just a guess, I think where it's at now is the people that are well financed, that don't have their loan called, are pricing the sale to get their money back out. Now they've given up on the idea of making a profit, but they're still trying to get their money back out. The thing that really changes things rapidly is when the lenders get involved. So say the guy just can't make his payments anymore on the loan. The lender seizes the property. Now the lender's got a different view on this. Sometimes they don't need the $5 million to use that example. They only need $3 million because that's what the loan was. The other $2 million was the money the entrepreneur put into it. So they're willing to slash the price down to $3 million and see if they can get a sale. Or if they're a large bank and they don't care about writing off a loss, they'll just put it on the market for whatever, just sell it. They just instruct the realtor to just sell it. So we aren't at that stage yet. The lenders seem to, if they've gotten involved, they seem to be holding fairly firm at the prices. But you can be sure that if there's 483 for sale at $5 million or higher, there's another 400 or so of baby boomers that are getting older who would like to sell because they were planning on using that money for their retirement. And but those people probably will just not list their house, or if it was listed, they'll pull it off the market because there's nothing forcing them to sell. It's just they were kind of counting on that for their retirement. They could actually get a loan against the equity in the house and live off of that for a while rather than sell it. So I'm sure there's lots of that going on too.
Are real estate listings likely to increase and be repriced now people are back to work from summer holidays?
I don't know how much of that. That's an interesting question. I don't think, there used to be in the real estate market, they said there was a huge flurry of activity late August because everybody had to get back to school and the kids have to go to school and you have to make the house transaction before September 1st because you don't want them to change schools in October or November. But that seems to be such a small part of it now that I don't think that seasonal thing is, but I do know that house sales really plummet going into December and January. So if people are desperate to sell, they're likely to try and get it sold within the next 30 days or so. And don't forget, we've got the federal election coming in October, and whether the current government gets reelected or whether a new government gets elected, the bad news about the economy and the housing almost always comes out after the election, not before the election.
Is the sentiment of sellers trending towards desperation and panic yet?
It's hard to judge that. It's like I say, I don't think people voluntarily panic. I think they're forced to panic. If they panic, it's because they've got a lender demanding repayment of a loan. And as I mentioned, I don't think we're quite at that stage yet, but it could happen any day. That would be ties back to your very first question, the Minsky moment question. And it all depends on what the lenders do. So it's up to the lenders. If they're willing to let the guy keep trying to sell his house for a little while longer before they get nasty about it, or whether they wake up tomorrow and say, hey, let's get all these houses cleared off at whatever price. It really depends on the lenders.
At what point in the bursting of the real estate bubble does it make sense to submit lowball offers on properties?
Well, we're not there yet for sure. As long as the bank economists are saying that we're just going through a slight correction and now we're on pause, and then that's a sign that's way too early. You won't get, if it's still the current owner that's involved, all you're going to do is insult them, right? Because they had it in their head that house was worth $1 million or $5 million or whatever. And if you come in with $500,000, they're going to be very insulted. So you won't get it. Where you'll get the bargains is when the lender takes over, and then they don't have an emotional stake in it, and that's where you start to get the bargain. So I would watch for that when you start to see, and that would show up in the foreclosure numbers. When you start to see a lot of foreclosures, then you can make your lowball offers at that point. We're not quite there yet.
In Vancouver, some high-end mansions are empty. They have boarded-up windows. They're overgrown with weeds. They have garbage strewn all over the front yard. Are there any solutions to this problem?
Yeah, when the property gets sold to somebody that's actually going to live there, it'll all be fixed up. How long until that happens, I don't know. I think we're getting close, though. I think, like we talked, the foreign speculators, the foreign money launderers are basically drying up now, and then eventually the properties will come back to a more domestic situation, as it should have been all along.
The BC government is forming a blue ribbon panel on balancing the budget. Is this just political optics?
Well, it's interesting reading. I just read the summary of the recommendations from the Alberta panel, and it's actually quite interesting. There's a lot of it I don't agree with, but in the case of Alberta, it's quite outrageous. Like, the per capita spending in Alberta is so much higher than BC. They use BC as the example, and the numbers are like 19% higher than BC, and in some areas, even more than 19% higher per capita. So if BC feels that their numbers are their spending is too high, then Alberta's going to have to adjust even further. Alberta's going to have a terrible time just getting down to the BC numbers because people are used to having that level of service. And as the Alberta Blue Ribbon panel pointed out, in a lot of cases, Alberta's not really getting better service than BC, but they're paying 20% more. It's just costing them more, but they're not getting better service. So I'll be interested to see what happens with the BC panel too.
Australia has created a Royal Commission on Housing. Should Canada do the same?
Absolutely, but as I mentioned, it won't happen until we realize we've had a crisis. And so whether that's October of this year or a year from now, I don't expect it'll be 5 years from now. It'll be happening sooner than that. But that's when calls for a Royal Commission investigation will be listened to. Until then, they won't be listened to. But it's interesting, though, because Australia, they thought that they were going to have this commission, and the commission was going to come back with a report saying, oh, everything's fine, there's no problem here, nothing to see here. It turned out to be exactly the opposite. They found all kinds of stuff that nobody knew about that was going on. We talked about one aspect of it with the personnel in the bank branches being forced to push larger mortgages on people than they could afford. So having looked at that experience in Australia, maybe Canada will be reluctant to do the same thing, because any thought that in Canada you could have a Royal Commission and not uncover some pretty surprising and negative things, it's just crazy. And I don't think they're that crazy. So they might not do it until they're forced to.
Do gold and silver look like they are finally in a bull market?
Sorry, what's that?
Do gold and silver look like they're in a bull market?
Yeah, gold. I don't know about silver. I don't follow silver, but gold the prices of gold, the gold bullion have gone up, and even more interesting to me is the prices of companies that mine the metal on the stock market, listed on the stock market, have been doing extremely well lately. And to me, that's where the real leverage is. And of course, it makes sense with negative interest rates. You're paying to keep your money in a deposit at a Swiss bank, so why not just buy gold? And at least you still have to pay a little bit of money for storage if you own the actual bullion directly, but at least you're not paying a negative interest rate to a bank for the privilege of depositing money with them. So interestingly, I haven't done a report on it. It actually would make a good analysis. Central banks all around the world, including China, have been increasing their holdings in gold quite dramatically. So but my preference has always been gold. I know lots of people look at silver because silver is only $18 versus $1,500 for gold. But gold, if we are headed for a financial crisis that pushes gold up from $1,500 up to $5,000 or $10,000, you usually get a better run in the end with gold, because that's the monetary metal. Silver isn't really that useful for monetary reasons.
Do you think the continued growth of electric vehicles will be good for the mining of battery metals?
Well, yeah, it already has been, and the people that do that sort of thing now, the big one is lithium for lithium-ion batteries, and it's very plentiful. But some of the other ones like cobalt and other metals, nickel, the prices have been pretty firm. And it's just in its beginning phases, so we'll see. It's also going to impact the other way, though, because the regular cars have a lot more of other metals in them, like iron and steel, than because of the engine block than electric cars do. So it'll have impacts both ways. And the electric car manufacturers are actually mostly Tesla, I guess, of actually finding ways to reduce the amount of metal quite dramatically, especially cobalt, that that needs to be put into the battery.
Is the continued growth of e-vehicles likely to be bad for the oil sector?
Well, it will be, and it's pretty significant. Like the use in light vehicles, so cars, trucks, that sort of thing, that can easily be converted to electric, is something like 50% of all the demand for petroleum worldwide. So at the moment, sort of in the 90 million barrels a day range. U.S. alone is about 20% of that at 18 million barrels. The thought was that the demand for oil was going to be kept going by China and India, where people would get vehicles, and then they'd need oil. And but what seems to be happening, especially in China and perhaps in India too, is instead of going through the combustion engine route, the people getting new vehicles are going to be either want to get electric or going to be forced by the government to go directly to electric and skip over the combustion. In China, they're really concerned about the pollution, and the way to get around that is with electric. So they've, up until recently, they had some pretty massive incentives to get electric over combustion engine cars. And I suspect although those incentives expire, I suspect they'll come out with new ones. Especially if there's Chinese manufacturers that make those cars.
Hilliard, you've had an electric car for some time now. What's your experience been like? Can you tell us about it?
It's coming up to 4 years now. I was just looking. It started in it's 3.5 years. I guess March was the of 2016, so it'll be 4 years early next year. And it's fun to drive. But one of the things you think about, well, I don't have to go to the gasoline station anymore. But the other thing that I didn't think about, which is equally positive, is you don't have to go for your oil changes and all the maintenance stuff. There's been really no maintenance issues. Just rotate the tires and fill the windshield washer fluid. And the one issue I had, Tesla has a Ranger that comes to your house and repairs it at your house. So you don't have to take it to the dealership. So that's been a phenomenal experience. And the cost of maintenance on average in North America is $1,000 a year per car. I was probably, because I had a Mercedes, I was probably paying more like $2,000 or maybe $3,000 average per year. So there's quite a savings there. When I bought my first Tesla, they were very expensive. The prices have come down. So the gas savings, which is $2,000 a year, plus say the maintenance savings, another so $4,000 a year savings. It still would take many years, 10 or 15 years, to pay down the difference. But with the new pricing being much lower, and the new model, Tesla has a Model 3, which isn't a whole lot more expensive than a comparable regular car. The payback is now probably down to 3 or 4 years, and people start noticing that. The other thing you notice when you drive an electric car is how interested people are in electric cars. Even guys you wouldn't expect, like driving pickup trucks, start asking you questions about how does it work, what's the range, and what's it like in the winter. Those are the most common questions. And especially younger people too, they're really interested. So I would say the future is pretty good for electric.
My questions are exactly range and reliability in cold weather. I mean, Edmonton isn't exactly a tropical resort.
So what happens in colder weather is there's positives and negatives. So the negative is the battery doesn't last as long. So it's about a 40%. In the really cold weather like we had last year, minus 40, the battery drops by 40%. So my 500K range dropped to 300K. And I did make one trip from Calgary to Edmonton, which is a little bit too tight to risk going 300K to Calgary. So I stopped for a top up at Red Deer for half an hour. It wasn't a big deal, but it was safety oriented. You don't want to run out, especially at minus 40. That's the negative. The positive is, and that, by the way, that only applies at minus 40. As long as it's sort of not colder than about minus 10 or minus 15, you don't really notice any change. But the positive is you get instant heat, And it's much more comfortable because regular car, you have to heat up the engine and all the fluids in the car. It can take like half an hour. But in electric car, it's just an electric heater. You turn it on and literally, even if it's minus 40 outside, within 7 or 8 or 9 minutes, you've got a warm car that you can do it. And you do it on your phone, on the app on the phone. So you're sitting inside, you turn on the heat in the car, 9 minutes later you walk out to the car and it's toasty warm. So that's a big positive for winter operation.
Hilliard, thank you so much for chatting with us.
Nice to be talking to you.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Marc Faber, Hilliard MacBeth, and thank you for listening. If you have any questions for our guests or the show, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Ray. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Ray, CEO and President of American Manganese. Welcome back to the show, Larry.
Great to be on the show.
Larry, what's the latest at American Manganese?
Well, there's always a lot of things happening, and, we were hoping that we might have some results back for the Stage 5, but that looks like it'll have to wait till next week, and we're having the show early today because we won't have our staff is pretty limited this week, so you won't be able to put out the podcast. We have to do that today, and so that's why we're a day early. And just as a reflection, I'm looking at the price of gold, which is way down, dropped $35 this morning, with silver down almost 90 cents. And but after that stupendous run up, it's going to correct, and that's the same as commodities are the same as stocks in that regard. So I think that the gold market is just going to continue to keep going up. That's my opinion after being in the gold market for over 40 years. And but I've noticed other things that are really important to remember for our shareholders, and that is that at one time in the nickel, cobalt, aluminum, NCA, the cobalt was the most valuable part. Now with lithium and cobalt fallen in price in the last year, nickel has gone up 50%. It's now the most valuable component, and so that's always a good thing. That when other prices go down, when you're dealing with multiple metals like we are in cathode recycling, then one will take the place of another one, and it's like a massive sulfide deposit. A massive sulfide deposit, as I said, zinc, lead, copper, gold, silver, those types of commodities in it, and there's always one that makes it, continues to make the company profitable through years when other commodities are getting hit. So it's the same with the cathodes. We've got several commodities in there. Some are going down, some are going up, and but we're going to maintain a balance, and that's great. So the big news these days is that the people are starting to talk now about how expensive and how the biggest holdback in recycling batteries is the high cost of doing it. I'm not sure where that comes from or what kind of research was done to come up with that statement.
because nothing could be further than the truth. You have a solution like ours with low reagent costs, and you can always calculate labor and power. So, and calculate what's going to cost you for the commodity, and, it sure beats going out and drilling anomalies and developing mines that take up to 10 years and cost billions of dollars in the long run. Our recycling process is, straight from once we get this pilot plant behind us and apply for other patents, I should say. Patents, we'll have 3 patents on a process where I don't know of any other company that has even one, and or maybe there's 1 or 2 companies out there that have one, and but the reality is, we've got the goods, and we'll continue to. Basically, we'll continue to advance that project. So, let's see, I'm trying to recall here. There was an important thing that I wanted to talk about, and that is that, you only have to go to our website to take a look at our business plan, our pro forma business plan, to see that there is money in recycling. And there are solutions out there, as we're starting to see from the numerous NDAs that we have, and that are outstanding, and the lineup of cathode materials that we have to test once we can bring the pilot plant back into focus for going through the entire samples. So that's something that I'm looking forward to. And we've got several of them, so it's going to take time and money, and but it's all in a good cause, because we can show these companies, these battery manufacturers, that hey, we can take your material, we can lessen the risk of getting materials for building your batteries. We can reduce the amount eventually of the mining for these metals, and we can save the environment at the same time. I mean, that's got to be a first-class situation. So, looking at the markets, up and down, and we've certainly been getting hit with all the good results we have. Somebody seems to be intent on trying to drive the price down. And that will change, because we have the goods. Just remember, when you're looking at a investment in stocks, the first thing you should always look at is just what is the asset in the company and the management and everything else. And you look at the asset, and we've had nothing but positive news and advancements in our recycling program, and and you're seeing a market that's growing fantastically fast. They're talking now about a slowdown in the lithium-ion batteries. Well, that may be a seasonal slowdown, but I don't see it an overall slowdown, and there's going to be tens of billions of dollars worth of cathode materials that are going to reach the end of life in the next 10 years. And we want to be part of that. We want to be a very plausible solution for that. And I think we're on the right track. So I think our shareholders should always look at the fact that the assets are good, and stop worrying about the day-to-day fluctuations, because day-to-day fluctuations affect all stocks. And let's march onward. I'm looking forward to getting stage 5 behind us and getting the results and filing the third patent. And I've seen that it's early. I don't have a lot of information. We've had to kind of move on the spot here. But I think everything is going good. Oh, the one thing I'd like to mention is that the letter that went out by the Economic Standard last week. In 1 week, it's had 11,000 openings, which is beats the record of 10,000 we had in June, and that particular article had 82,000 openings. So I think we can look forward to similar numbers, and it's always good to know that the company's getting that type of an exposure. So, but that pretty much ends my podcast, Jim.
Larry, where are you traded, and how can people get more information about American Manganese?
We're traded on the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. The company has a website at AmericanManganeseInc.com where anybody can do a lot of due diligence on the company. And you can email the company at LREAUGH at AMYMN.com, or you can phone us at 778-574-4444. And before I leave, I'd just like to say that we're a critical metals company, and we seem to be in the spotlight, not just at the recycling, but with the criticality of what's happening in the U.S. and around the world and their dependence on imports. Our manganese property has got to be another big diamond in our cap. So, we're in the right place at the right time, and as soon as people start to recognize that we do have a solution, we should start to benefit from that.
Larry, thanks for the update.
You're welcome, Jim.
I've been speaking with Larry Ray, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on September 5th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.